When most people think about investing, they picture a room full of people in suits, yelling as red and green numbers flash across a screen. But most of that is theater. In reality, the wealthiest investors on the planet often use an approach that is repetitive, steady, and, to be honest, completely boring. We are going to walk through the exact steps to buy your first piece of the market with just a few dollars. You'll see why making your money move as quietly as possible is the most effective way to build a fortune. Intimidation is the real danger here. Most people lose more money by staying on the sidelines because they're overwhelmed than they ever would by making a simple mistake. Keeping your cash in a standard savings account feels safe. You know exactly what is there. But uninvested cash acts like a lazy employee. It sits there taking up space, doing absolutely nothing to help you build your future. While that money is sitting still, an invisible force is working against it. That force is inflation. It is the reason a bag of groceries or a cup of coffee costs more today than it did 5 years ago. Because everyday items are getting more expensive, cash that isn't growing actually buys you less every year. It's losing value while you sleep. To grow your wealth, or even just keep your head above the rising cost of living, you have to give that money a job. You have to put it to work in the market. A savings account is perfect for a short-term emergency fund. But for your long-term goals, leaving cash in a bank account for decades mathematically guarantees a loss against inflation. Think of a stock as a legal proof of ownership. Buying one share means you now own a tiny piece of a real-world company with a right to its future success. However, placing all your savings into one single company is a massive risk. If that specific business goes under, your investment disappears along with it. Trying to pick which specific company will be next year's big winner is a form of gambling. It relies on luck rather than a strategy. Imagine walking into a massive grocery store. Buying a single stock is like betting all your money that everyone will only buy one specific brand of cereal this year. If customer tastes change, you lose everything. You can avoid that guessing game by using something called an index fund or an ETF. An ETF is a shopping basket that automatically fills with a tiny fraction of every item in the store. You own a sliver of everything. If one goes bad, the impact is minimal. Your investment survives, supported by hundreds of other growing companies. Spreading your money out this way is called diversification. Using an ETF to buy the whole market removes the anxiety of finding the perfect company. You are simply betting on the growth of the whole economy. As companies in your basket grow and pay out profits, your investment balance begins to rise. This creates compound growth, where the money your investment makes starts making its own money. It's like a snowball rolling down a hill. Every rotation picks up new snow, making it larger and heavier with every foot it travels. The hill isn't perfectly smooth, though. Market crashes and dips are unavoidable bumps on the path that will temporarily shrink the value of that snowball. This is where most people make their biggest mistake. They see a dip, they panic, and they sell everything right at the very bottom, turning a temporary drop into a permanent loss. The boring investor does the opposite. They ignore the noise. They know the market historically always recovers, so they leave their money exactly where it is. In the long run, the time you spend in the market is much more important than trying to guess exactly when to jump in and out. Turning these rules into reality only takes 3 steps, and you can start them today. Step 1. Open a regulated investment account online. These work a lot like a standard bank account, and many of them no longer charge extra fees for buying or selling your shares. Step 2. Add some money. Only transfer an amount you're comfortable leaving untouched for years, so it has time to grow. You don't need a fortune to start. Thanks to fractional shares, you can buy a tiny slice of an expensive ETF for as little as $1. Step 3. Set up an automated transfer. Have your account buy a small amount of your chosen ETF every month without you having to think about it. Automation removes emotion and hesitation from the process. It turns wealth building into a background task that happens while you're busy living your life. Successful investing relies on patience and a long-term plan. It works best when you ignore the hype and focus on steady growth over decades. This chart shows how much timing matters. Starting now, the yellow line, allows compound growth to do the heavy lifting. Waiting 5 years puts you on the gray line, meaning you must save much more every month to reach the same place. Buy a broad basket of companies, add to it consistently, and let time do the work. True wealth is built quietly over the years. To find more tools to start your journey, click the link and subscribe to MoniTab.